Hello everyone and welcome back. In today's video we're going to talk about GMX. GMX is a decentralized perpetual exchange that lives on Arbitrum, so you can do all of this on layer 2, which is great if you're trying to avoid the high fees of ETH mainnet. Now one thing that we will get into, which is very exciting, is GMX's Earn platform, which allows you to earn fees from the platform and collect a pretty high APR on ETH or other crypto assets. Now, before we get into the yield opportunities, I do want to talk about what GMX as a platform actually does. It is quite similar to DYDX, which I have a video on and will link in the top right. But if you haven't seen that video, GMX essentially allows you to get leverage on different crypto assets. So if you look here on the right here, you can see I'm clicked long here. So I'd be longing UNI. And I inputted just 1 ETH of how much I'm willing to pay. And you can see that there's a slider here to pick how much leverage exposure I want on the UNI token. So the more I slide this to the right, the more exposure to UNI I'll have, but my liquidation price also goes up as a consequence of getting more leverage. So let's assume that we really love the UNI token. We want about 10x leverage on it. And you can see here that I'll get an entry price of $21.65, which is the current price of UNI you can see there. And you can see I'll actually get liquidated at $19.70. So if UNI drops below that price, I'm liquidated. But as long as it stays above that, I'm going to be fine and I can close out my position in the green. You can see here, I'll just click here and you can see right now they support 4 different crypto assets. So they have ETH, BTC, Link, and UNI, which are some of the biggest Ethereum-based ecosystem tokens. And then of course, BTC. And to do this all costs a small fee of about 0.1%. In this case, it would be $66 on a 1 ETH position. The other thing you have to be mindful of is the borrow fee. You can see that here. It's also known as the funding rate. In this case, it's positive. So this means I have to pay this percentage per hour to borrow the UNI. And that would mean that I'm actually going to get paid to short this token because the borrow fee is positive. Now, if the borrow fee were negative, that would mean I would be getting paid to long this asset and I would have to pay to short it. So you can see that's how they balance out markets and make sure that protocol is earning revenue. So in addition to going long on a token, you can see you can also short a token with leveraged exposure. And they also support swaps between all the crypto assets on their platform. Now, if you're making a very big swap on Arbitrum, definitely check GMX. And if you're swapping between some of these main tokens, you're probably going to get a better rate on GMX than Uniswap because of how the protocol is designed, which I'll get into in just a minute. So where are all of these assets that you're getting leverage on being stored, and how can you actually get a yield from providing these assets? Well, it is a bit complex, but I will walk through it. Essentially on the platform, there's a GLP token, which is basically a GMX liquidity token. And this GLP token is a collection of these 5 crypto assets: ETH, BTC, Link, UNI, USDC, and USDT. So essentially, if you buy the GLP token by providing any of these crypto assets, you're getting exposure to all of the other assets in the pool. You can think of it like a balancer multi-asset pool. Another comparable would be Curve's Try Crypto. If you deposit ETH, BTC, or USDC into that Try Crypto pool, you're getting exposure to all of the tokens there, not just the token you deposited. It's the same as with GLP. So let's say you have a lot of ETH and you're willing to take on exposure to BTC, Link, UNI, and these stablecoins. Well, you could deposit your ETH and then get a pretty substantial yield for doing so. So I will switch over to the yield or earn tab here and I'll just break down what I mean by that. So this page does get a bit confusing, but just focus on this GLP section for now. So you can see if you hold GLP, you're getting an 84% APR. And if we hover over that, you're going to see that you get a 37% yield in ETH that is not escrowed. What that means is this 37% is just free and clear that you're earning on your position, and it's denominated in ETH, which is great because all of the platform fees are collected in ETH. Now, where it gets a bit confusing is this GMX APR. You can see it says it's escrowed there, which essentially means you don't have access to those GMX rewards right away. They actually vest continually over a 1-year period. You're able to compound your GMX, so you're earning a yield on it like regular GMX, or you can actually start escrowing it, which again takes a year. And the details are very complex, so I will link you to the rewards Gitbook page that they put out, which gives you the full details on how to take advantage of the yields here. Now, of course, there is a GMX governance and fee token, and that is in the top left here. And you can see you can stake that token for a 27% APR. About 6.7% of that is ETH, and 20% is in that escrowed GMX. In addition, staked GMX gets you multiplier points, which can boost the yield you earn on GMX. So again, definitely take a look at that Gitbook if you're interested in maximizing your yield here. One thing I did want to mention is that 20% of platform fees actually accrue to GMX because they're deposited in that GMX liquidity token and are used as a floor price fund. In addition, GMX owns the GMX ETH Uniswap v3 liquidity, and it deposits those earnings into the floor price fund as well. Now, one thing I wanted to share is a GMX Analytics Dashboard, which I will of course link below. You can see some interesting things here like total volume and total fees, which are pretty high at 5.6 million. And you can see that there's about 90 million in this GMX liquidity pool. Now, I want to scroll down because there's one thing you need to note if you're going to be providing liquidity for that GLP token. Essentially, by providing liquidity for GLP, you're collecting fees and losses from traders. So if a trader loses their position and is liquidated, the GLP fund accrues those fees. But in addition to that, the flip side is if a trader earns a lot of money from a trade, it gets paid out from GLP. Now, if we look at this chart of GMX traders, we can see that profit and loss basically balance themselves out, but it looks like there's a slight bias towards profit as opposed to loss, which is pretty impressive because generally most traders, when they take on leverage, end up losing money. This is definitely something to keep in mind though, but historically it has been about balanced 50-50, which means by providing liquidity to GLP, you're not really losing out on having to pay traders for winning trades. Now, one useful tool I wanted to share was an impermanent loss calculator for this GLP token in case you want to deposit there. Now, because this is a liquidity pool similar to Balancer, it's going to receive impermanent loss. So I just weighted it out as it's actually weighted in the pool. Let's just say BTC can 2x from here, ETH gets about a 2.5x, Link a 2.5x, UNI as well, and USDT and USDC stays stagnant. In that scenario, you'd only face about a 7.4% impermanent loss, which isn't too bad, but obviously it's not ideal. But of course, I think we would all be very happy if ETH and BTC went up by this much. Now, in addition, you're also taking impermanent loss on the downside as well. So if ETH and BTC and Link and UNI all go down, you're going to have impermanent loss as well as a decrease in your token value. So don't think that if you deposit USDC and USDT that you're always going to pull out that same value. You are taking on exposure to the other assets in this pool. Now, because GMX is on Arbitrum, I can't go over the on-chain analytics through Nansen just because Nansen isn't on Arbitrum yet, but I did want to briefly touch on the CoinGecko page. Now, you can see that GMX is trading at a fully diluted valuation of 358 million, which is pretty low as far as a lot of these tokens go. And if we look at the token since inception, it's done fairly well, maybe about a 50% move to the upside, but when you compare that to ETH, it really hasn't performed all too well. Again, I generally recommend people don't handpick tokens to purchase, and I'm not saying you do that here, but at least with this token, you're not buying it at a crazy multi-billion-dollar valuation, so there is some more room for the upside. Now, that is all I wanted to cover today. I want to thank you all so much for watching. If you enjoyed the video, please like it and subscribe if you haven't yet. Now, with that said, I will see you all in the next video.